If real estate metrics were a party, okay,
Okay.
which one would you be?
I'd probably say IRR.
Yeah. Well, all right. Why the difficult one?
Yeah, true. I mean, it might seem complex,
Uh-huh.
but once you get to know me, you'll know I'm about maximizing fun.
That's awesome.
That's what it comes down to. So
You do maximize the fun, and yes, you are complex.
so it's not about the amount of fun; it's about the quality of fun.
100%. Hey everyone, welcome back to another episode of Real Estate Roundtable with MRTG Capital. My name is Tom Goodge, and as always, I am joined by my friend and business partner, Mr. Mike Rohm. How's it going, brother?
I'm doing great. How are you doing?
Hey, we're here again. This is awesome.
Right.
I'm doing great.
That's right.
So today we're going to just continue on the trend, right? We're going to go over, more educational topics for everyone from an investment perspective. And today, real estate metrics was top of mind, right? We wanted to be able to, especially because we've been going over so many deals, and we'll have some here very shortly to present to everyone. And one of the things that comes with a real estate deal is, hey, show me the money, right? What do the numbers look like? And with that come a lot of terms, a lot of jargon that everyone may not know.
Absolutely. It's normal in our world. We say it all the time, but absolutely.
Yeah. So today we're just going to kick off on a couple things. We'll make it fast paced, rapid for you, but we definitely want to make sure that it's a ton of value. So with each one, we'll make sure the video editing team actually goes through and does a cut scene to actually give an illustration. So you're not just having to stare at our mugs, but we'll make sure that, you can actually see, okay, what are they talking about? All right. So we'll do the best that we can to illustrate each one of these. So, all right, just to kick things off, let's talk about average annual return, or AAR. All right, so what is AAR, or average annual return? Well, Mike, quite simply, it provides a snapshot of the return on investment over a set period, and that's usually a year, right? So, and this is where, once again, we'll make sure that the team has a good, visual, demonstration for everyone. But, to calculate AAR, for those of you at home, you take the total return over a certain number of years, and then you're going to divide it by the actual number of years. It's pretty simple, right? It's just a way to smooth out the returns over time and give an average. When this is taking place, and like I said, we need an example, right? Like, just I'm trying to think of, off the cuff here. Just think year one, let's say you got 10%, year two, 12, year three, you got, hey, you're up to 14%. But each one of those you're taking and, adding those up, and then you are going to divide that over the number of years. Now, the thing with this number, this is one that you're going to see quite often, right? AAR, like the one thing that you may see for, like, if on Facebook, and maybe it's just our Facebooks, right? But we have tons of real estate opportunities that are out there for accredited investors. And one of the first metrics that you will see is AAR, normally, right? The average annual return. So this is, it's a pretty straightforward metric, but at the end of the time, at the end of time, not at the end of time, at the end of the day is what I was going to try to say. It does have a limitation, right? And the biggest limitation of that is it doesn't take into account the effects of compounding. So it's a great metric just to give you some quick fact, hey, do the numbers make sense for me from an investment perspective? Right? Because you may have certain minimums that you'll have from an AAR side of the house, but it's just one, and there's many metrics that you need to take into account for any deal.
Yep, absolutely.
So, with that being said, I gave the simplest one as always. But for you, Mike, let's hit on IRR.
Yeah, the internal rate of return is what IRR stands for.
Okay.
The IRR is a metric used to measure the profitability of investment over time. It's the rate at which the present value of future cash flows equals the initial investment.
Makes sense.
So, I mean, simply put, it's the rate where the net present value of all cash flows is zero. In simpler terms, it's the break-even rate for your investment.
Makes sense.
Yeah. So it's particularly useful because it's considered the time value of money. So $1 today is worth more than $1 tomorrow. So In that terms, the IRR gives a clear picture of an investment potential compared to the AAR.
Yeah, and both, and you're going to see both of those, right? And sometimes you'll see them right underneath of each other.
Absolutely.
Like you'll see AAR, then IRR will come right underneath, and pretty much any advertisement that you're seeing publicly offered.
Right.
And for those of you keeping track at home, that public offering, what would it be under? 506C, if you were paying attention to the other episodes.
That's right. Go back and watch that one if not.
Good deal. So what do we got up next here? So what do I have? I have cash on cash return. So cash on cash return. Okay, this is a pretty straightforward one, and that's probably why I got this one again. So cash on cash. So this metric, I mean, quite simply, it measures the annual return on the cash invested in a property relative to its cash flow. It's pretty simple, right? So how is this done? It's calculated by dividing the annual pre-tax cash flow by the total cash invested. And once again, for those of you paying attention at home, what is cash flow? We talk about cash flow. That is the money that's left over after all of the bills are paid, after property management's paid, the property tax is paid, mortgage is paid. What's left over is called cash flow. So that's how we're getting to this metric. What's flowing back to you, the investor. So one big item here, for investors who rely on financing, this metric is particularly valuable as it focuses only on the cash component. And what that really does, it provides clarity on your immediate returns. Cash on cash return, that is one that is very normal for you to talk about as well.
Absolutely.
Hey, what's my cash on cash return? That's fair to ask.
Yeah, I mean, it's a return on the cash you invested. I mean, that's really what it's broken down to, and that's what everybody wants to know.
That's right. And then next up here, what do we got? We have, this is a good one. So this is at least one that's not crazy. Equity multiples.
Yeah, exactly. So equity multiples, it's just a metric that gives investors a quick look at how much total cash they might get back from an investment. So really how you calculate it, you divide the total distributions received from the investment by the total equity invested. So value greater than 1 indicates a positive return, while less than 1 suggests a loss. So it's really a snapshot of your return, but doesn't tell you how long it took to get to that return.
Yeah, I guess when we start talking about time value of money, right? Like that's one of those things where it's like, hey, that's a great equity multiple. How long did that take? A decade. Wait,
yeah. That's what it comes down to. So, I mean, the higher the number, the shorter the time period, fantastic. So if you drag it out, a little different. It still can be good. It still can be great.
That's right.
But
buyer beware on what the equity multiple that's being advertised is.
Yeah. Got to take it more in context.
Good deal. So next up, what do we got here? All right, I got a fun one. I have the net present value. So this one, I mean, definitely it's not, maybe last, but it's not least by any stretch of the imagination. So you may hear of this as NPV, the net present value. It's quite simply, it's a metric that is used to estimate the profitability of an investment. So the net present value. So what does it do? It considers both the timing and the amount of the cash flow that you receive. So that's discounting future cash flows back to today's value, back to that whole time value, right? And it's giving a clear picture of whether an investment it's worth pursuing or not. So it's just another, tool in your toolbox, for you to be able to judge or gauge an investment by. And just quite simply, a positive NPV, it indicates a potentially profitable investment, while a negative one, it suggests that it's the opposite. That's pretty much it that we covered. We wanted to rapid fire. I mean, I can completely appreciate when we're going over, even I'm sure there's plenty of those out there like us that do get all nerdy about metrics and what it means, but also want to take into account that too, we don't want to drag out something longer than it needs to be. So we'll get you some good visuals, what those are. And then if you want to have a deeper conversation, definitely reach out to us as well. But I had something for you. So here's a question.
Okay.
I've been sitting on this one. So if real estate metrics were a party, okay, which one would you be?
So one of the metrics, which one would I be?
Yeah.
Okay. I'd probably say IRR.
Yeah. Well, all right. Why the difficult one?
Yeah, true. I mean, it might seem complex, but once you get to know me, you'll know. But I'm about maximizing fun.
That's awesome.
That's what it comes down to. So
you do maximize the fun, and yes, you are complex.
So it's not about the amount of fun; it's about the quality of fun.
100%. There you have it, right there, Mike Rohm, who never missed a zinger in his life. I love it. So awesome. I love every single one of these, brother. So I guess, that's pretty much it for today. I guess once again, when we talk about real estate metrics too, in all seriousness, remember when you're reviewing a deal, make sure that you have your CPA involved. Make sure that you're reaching out to your financial advisors, to review a deal with you, right? Because it has to be congruent with your investment needs, and you want to make sure that the numbers that are being presented, especially when you get all the offering memorandums, the private placement memorandums, when you get everything in front of you, make sure that it is actually what it says it is, right? So don't take it as face value. Make sure that you go through with your financial team, your legal team, and all that good stuff. There's the disclaimer for today. But you got anything to end us on?
Yeah, stay informed, keep learning, and see you all on the next episode.
You did have another zinger right there.
That's right.
Love it. Awesome. Hey, thanks everyone.
Thanks, everyone.
Have a good one. If you would like to connect, please head on over to MRTGcapital.com and request time to meet with us to answer any questions you may have about real estate investing through a syndication. We partner with small groups of investors just like you, and we're always reviewing deals that could be of interest to you.